Hey everyone, and welcome back. Today's video is likely going to be an eye-opener for a lot of people because you might have heard me say that when you're buying a business, you need to estimate the future cash flows of that business. What are the future cash inflows that you will receive from that business? And the reason why I say this is because it is the exact method that many of the greatest investors of all time, such as Warren Buffett, have used to outperform the market over many decades. But despite this, I constantly get asked why I use this method over other methods. And I think the most common question I get is, why do you no longer use Phil Town's margin of safety method? Why do you prefer to use a discounted cash flow, estimate the future cash flows of the business versus doing some kind of Phil Town shortcut method? So today I'm going to be explaining what I mean by estimating future cash flows. I'm going to explain how that figure converts into us making money. And then I'm going to show you an explicit example of how accurate this method really is at predicting what we make as investors. So that from this point onwards, whenever you hear me say in a video that we need to estimate the future cash flows of the business, you will understand what I mean, how to apply it, and exactly why it should be your main focus as an investor in the stock market. Also, towards the end of the video, I'm going to be sharing an example and using a piece of software called SHARESIGHT to track the portfolio gains in that example. I'll leave a link to SHARESIGHT down in the description below, and I'll explain a little bit more about it later in the video. Now, before we get to that example and show you exactly why this method makes the most sense, I think it's important to give a summary of what I'm actually talking about here. And I think the easiest way to summarize value investing and calculating the intrinsic value of a business is estimating the future cash flows of that business. And you've probably heard me say this many times: estimate the future cash flows and then compare that to the price we have to pay for the business. And ultimately, as a value investor, we want to be paying a low price for the stock in relation to the large amount of cash flows that that business will produce and then deliver to us. But just explaining that probably leaves a lot of people scratching their heads. What do you even mean by cash flow? And how does that cash flow that the business is producing convert into us personally making money? So first of all, whenever I say cash flow, what I'm referring to is a figure called cash flow for owners. Now, Warren Buffett calls this figure owner's earnings. So if you ever hear owner's earnings or cash flow for owners, both of them mean pretty much the exact same thing. And on screen, you can see the formula for it. Cash flow for owners equals operating cash flow minus maintenance capital expenditure. Now, I have a video on my channel dedicated to explaining cash flow for owners, showing you exactly how you can calculate it from the financial statements. So I highly recommend you check that out after this video. I'll leave it linked down in the description below. But for now, what you need to understand, all you really need to understand, is that cash flow for owners is basically all of the money produced, all of the cash flow produced by the business that's left over after normal business operations and also after maintaining physical assets. So after maintaining machinery and buildings and land and that sort of thing. And this money that is excess cash, excess profit that is not required for the normal operations of the business can then be used by management in a couple of different ways. It can be used by the business either to keep it in the business, right? Or it can be distributed to shareholders. So let me first go through some of the ways that money is kept in the business and used within the business. When some or all of that cash flow for owners figure is kept in the business, it could be used for things such as providing a cash buffer. So literally just the business sticking that money in the business's bank account and securing their balance sheet, protecting their assets. Or it could also be used to pay down some of their debts. It could be used to make an acquisition, or it could be used to invest in the growth of the business. And there's one important thing that happens when money is kept in the business and used for any of those things is that equity goes up, right? So equity being assets minus liabilities, right? It's the portion of the assets that are attributable to shareholders. And it makes sense that this goes up, right? If they keep money on as cash, then they have more assets. Now, so the difference between assets and liabilities would be larger. Same thing is true if they use some of that excess cash to pay down debts. They have lower debts, same amount of assets, therefore higher equity. And over the long term, higher equity is associated with higher share prices. Both of those two things, equity and the share price of a business, move up over the long term. Take Thor Industries, for example, which is one of my personal investments. Here's a graph of the equity figure compared to the share price over time. Now, I've scaled the equity by a factor of 30 just so that they can be aligned side by side, but you can see that over the long term, they move in the same direction. And this is by no means perfect, right? Again, looking at this chart, you can see that there are certainly times where the market is overly excited about Thor Industries as a business, and as a result, the stock price goes up faster than equity. This happened in the late 90s, again in the mid 2000s, and again leading up to 2018. And of course, there are also periods where the market is irrationally negative about the business. These are times such as 2008 during the GFC, and also as recently as 2019. So there are certainly periods where they are not aligned, but over the long term, over a 10 or more year period, they are very, very closely aligned. So now you might be wondering, well, Hamish, if it's actually equity that is the best predictor of the stock price going up, then why are we talking about cash flow for owners? Why don't we just focus on equity? That way we can predict where the stock price will go, and that's how we make money. And that's a good question, but the reason why we don't just focus on equity and the share price is because the share price increasing is not the only way that you make money as an investor. Remember, you also make money when the business distributes some cash to you in the form of a dividend. So a dividend, remember, is if a business has excess profit, they can deliver that to shareholders directly. That will be money that's going straight into your bank account. And you actually also benefit from share repurchases or share buybacks, but we won't talk about that in today's video just for simplicity's sake. But it is that cash flow for owners figure that shows us the total amount of cash that is delivered to us over the long term, right? So that cash flow for owners figure, remember, it's excess cash after normal operations and after maintaining the assets of the business. Then some of that money might be kept in the business to pay down debts or to invest in the growth of the business. That will increase equity and drive a higher stock price over the long term. And then some of that cash figure may be paid out as a dividend, which will of course be delivered to you directly. So that cash flow for owners figure shows us a combination of what you should earn from the share price going up and the dividends that the business pays. And to tie this all together very nicely, I want to show you just how accurate cash flow for owners was at predicting how much you gained when investing in Thor Industries over the past decade, okay? This will probably blow your mind at how accurate this figure was at predicting the stock price increase in combination with the dividends delivered by management of Thor Industries. So the first thing that I did was I calculated what cash flow for owners was in each of the years from 2010 to 2019. And then I added it all together to get the total amount of cash flow for owners that Thor Industries produced during that 9-year period. And that figure was $2.9 billion for the whole company. And if you divide that by the number of shares, it equates to $52 per share. So they produced $52 per share in cash flow for owners in the period between 2010 and 2019. So now what we can do is we can use something like SHARESIGHT, which is a portfolio tracking software that I've personally been using for a number of years now. And we can buy, or we can simulate buying one share in 2010 and then selling that share in 2019 and see what was the gain through a combination of the share price going up and all of the dividends paid over that 9-year period. And as you can see, if you had bought one share in 2010 and sold it in 2019, you would have gained $40 per share in the stock price, and you would have gained $14 per share in dividends for a total gain of $54 per share. So just to summarize, Thor Industries between 2010 and 2019 produced $52 per share in cash flow for owners, the figure that I think is the best estimator of what we get back as shareholders. And using SHARESIGHT, we were able to see that if you did in fact hold one share during that period, you would have earned $54 per share, slightly above the cash flow for owners figure. And what that essentially means as an investor looking forward is that if you can come up with an accurate estimation of what the future cash flows, what the cash flow for owners figures for a business will be over the next decade, then you can figure out reasonably what you should expect to get back from that business. And then of course you can compare that to the price that you're willing to pay. So for example, with Thor Industries, we saw that over the past decade, they produced about $50 per share in this cash flow for owners figure. over the next decade, let's say I project that they can produce $150 per share in cash flow for owners, then I can compare that to the stock price and figure out if I'm happy with that relationship, right? If the stock price today for Thor Industries is $50 per share and I estimate that I can get back 150, am I okay with that relationship? Or maybe I want to pay $40 per share. Or maybe I'm happy to pay up to $100 per share in order to get back 150 over the next decade. That is the kind of relationship that you should be thinking about when you're trying to value a business. And if you want to keep track of your portfolio, then I highly recommend you go check out Shareside. I've personally been using it for over 3 years now. And if you've watched the channel for a while now, you know I don't do a lot of sponsorships. In fact, I think Shareside is the only thing, besides my own stuff, I think Shareside is the only other company that I've promoted in 2020 entirely. So I don't just promote anything. This is a software that I've personally been using for many years. It is brilliant for keeping track of all of the different types of gains that you experience as an investor, your capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. It'll calculate your currency gains, which is super important. If you have international shares or you hold foreign currencies, there is a significant change that happens between different currencies, and you need to be able to see the impact of that on your returns. And Shareside also produces a number of different reports, I think up to 10 different reports that can show you the performance of your portfolio, your capital gains tax report, your dividend income tax report that you can hand off to your accountant, probably end up saving you some money. So there's a bunch of great features, and you can also try it for free. There's a free plan. So there's a link down in the description below. You can use that link to get a free plan for as long as you want if you want to try it out. And you can also use that link to sign up to a paid plan if you're interested. And at the moment, Shareside is offering my viewers 4 months free when you sign up to a yearly subscription. So if you want to sign up to a paid plan, use that link down there and get yourself a whopping 33% off. But if you just want to try it out, check out the free plan and use it for as long as you want. And if you want to check out a full review that I did on Shareside of all of its features, I'll leave that video linked down in the description as well. I go through every single thing that you get access to for all of the different plans. So if you're interested in checking that out, you can as well. But I hope you guys enjoyed this video. I hope you got some value out of it, and I'd love to hear your thoughts down in the comment section below. But other than that, hope you guys have a great day, and I'll see you in the next video.